Markets are relatively calm today after the huge Fed rally yesterday, with Chair Powell coming out and surprising everybody with his most dovish statement since probably back in June. For whatever reason, he wanted to give investors and markets a little glimmer of hope that he can engineer a soft landing in the economy. The key statement right off the bat that triggered the huge rally in the markets yesterday was he sees the possibility of slowing the pace of rate hikes as soon as December. So nothing was certain, nothing was given. It's not a pivot, it's not a reversal. He said the possibility of potentially slowing the pace of rate hikes, meaning they're still going to raise rates. They are still going to, and he reiterated all of the hawkish stuff, that they are still committed to fighting inflation. They're still going to raise rates to the Fed target of 5%, which is about another 100 basis points to go, and that they're going to keep them higher longer and wait for the data to tell them otherwise. So the markets today are backing off a little bit and digesting some of that, waiting for the jobs report. And then December 13th and 14th are the big days where we get the next CPI on the 13th for November. Those are November numbers that come in December, and then the Fed's response to it. So the debate now, as usual, is 50 versus 75. Consensus in the message that was sent yesterday, the telegraphing, was that 50 is what they are likely to do. And with what's left for them to do, the most likely thing is 50, 50, 25. So that's kind of what Powell triggered or telegraphed yesterday in terms of the next few Fed hikes. And then they can pause at that point based on data coming in, inflation readings and things like that, and kind of wait and see. So that's what the markets are celebrating. So right now, the market narrative, what investors are looking at, what the markets are thinking. When I say markets, that means investors all around the world. Markets are forward looking, and they right now have priced in that inflation has peaked, that the Fed is going to reach peak hiking and pause with the next three meetings, 50, 50, 25. That's what they're kind of looking at right now. So they're seeing and pricing those things in. And of course, we have the jobs information, coming out tomorrow. Jobs report coming out tomorrow. The market was down a little bit ahead of that, just barely, half a point on the Dow, flat on the S&P, flat on the NASDAQ, just up a little bit, down a little bit today, ahead of that expected Friday jobs report. So we'll see where that comes in to, that's the biggest issue that the Fed still has, that is their sticking point, is a stubborn jobs market, and inflation again rose 0.2 instead of 0.3. So the market rallied on less than stellar economic data, but the same, the same point is that the algorithms and the technical trading, algorithm formulas and short covering was triggered on the Fed statement of slowing the pace of rate hikes. So that was a lot of fun to watch that rally. So the real question is, where do we go from here? So, is this going to continue on? That's what everybody's debating right now. Is this going to continue on? We're going to get back to all-time highs, or what are we looking at here? So what we can look at is recent history. The Dow's really reached out quite a bit. NASDAQ, S&P just had a fairly standard par for the course bear market rally. The Dow is the one that reacted the most, but it did last time as well, off of that June rally, which was about 15%. This time, this is a nice bear market rally of about 20%. So the NASDAQ didn't do quite as well. NASDAQ only put in about 15, almost 16% back in June. NASDAQ put in a 24%. So NASDAQ and S&P had the biggest rally back in June, whereas that's 20% on the S&P. Whereas this time around, it was the Dow, and that's a rotation of capital into safety. So where do we go from here? So the NASDAQ and the S&P look like, standard lower highs. The trend is still on track, lower lows. That's the S&P, that's the NASDAQ, lower highs, lower lows. The trend, still not broken on these. If we just draw the, major trend lines here, still within trend on the NASDAQ, still within trend on the S&P here. And the Dow Jones obviously broke the trend as this was trending down. So this is your key to watch right here to see if it comes back to test this level here and retraces a little bit. But the real question is, where does it go? So if we look at the VIX, okay, so the strategy in a bear market has been, if you buy the VIX in the 20s, which right now the VIX is at a 19, or sell the VIX in the 20s, which the VIX is a 19. So here we are in December. This was August, and this was the June timeframe. This was April timeframe here, but here was your June rally right here. And then, of course, back in, January, April, August, and now December, these are your low VIX readings in the 20s. And then the time to buy is when the VIX is at that 30 level. But, back in February, we're in the 40s, back in April and May in the 30s. And then the most recent was October in the 30s. And that's the ultimate time. If you just bought when it was in the 30s, sold when it was in the 20s, then you'll be up. You're generally up the trend. So let's look at what that equates to as far as the Dow goes. So the last three, March, April, then that June timeframe, and then August. So let's just go on the Dow. And here's your March, April timeframe. There's the June timeframe. And of course, the August, September timeframe there. So we're looking for when the VIX is low, it's time to go. When the VIX is high, it's time to buy. So let's look at this August 22nd on the Dow. So that's right around this area here, right here. August 22nd, right there. The Dow peaked out on August 22nd for the last time. We're at, when the VIX was at 20, that's where we are right now. VIX at 20. That was August 15th, actually. So right in this area here, 15th in that time frame. Let's look at the NASDAQ, same thing. That August timeframe, S&P, same thing, August timeframe. The last one was June, right in here. And what is this one here? March 30th. Let's take a look at the VIX on March 30th. I think we talked about that. Right in here is June. Where was March? February, March, right up in here. In this area, the 30th was right around in this area here. So these are the areas of the lows. Let's look at April. What is this here? That's April right there. So let's take a look at the S&P in April. Right about here. There's a March, April, right in this area here. So each time the VIX was down in the 20s is when it hit that trend line that we're looking at and rejected. So pretty straightforward that if you followed that formula where you sell in the 20s, you buy in the 30s, you're pretty much safe all the way through. So that's what we're looking at. Now, the other key thing, obviously, is, this is your volatility index, the VIX that we're talking about. The Dixie, the dollar, has retraced major. So, these were 3 to 4% retracements. This is a 7% retracement here. That's the biggest retracement we've seen on the dollar so far, 8.8% to date. So the question is this a complete reversal on the dollar, or is this going to continue up? And when you look at the same time frames on the dollar and look at these drops right here, so the last time the dollar dropped like that, where's August? Let's see, here's your August, here's your July time frame here. There is your August time frame right in here. And then let's look at the 10-year, same thing. 10 years had some nice drops here. This retracement here, again, is this going to be, a continuation down, or is this, just a retracement looking for support? And again, this is your August time frame when the dollar went on the last run. There's your March, April time frame when the dollar went on the, this is 10-year. I'm sorry, not the dollar, but the 10-year. The last two times we touched these downtrending trend lines here. The 10-year was up as the market was going down. Generally, the dollar was going to be up. There's June, the same time the markets were down, August. So those are the things I'm looking at for the traditional markets. I hope that makes sense. I was kind of digesting and, looking through some of this stuff and working through it, as we were talking, or as I was talking there. So here's Bitcoin right here. Of question here is this range just going to continue on? Bitcoin reached out to 17.1 yesterday. I said we could get as high as 17.5, 17.6 and test this recent high here. Didn't quite make it before it reversed back down into the 16,000 level. But again, nice range here from 15.5 up to the 16 or 17.5 range that we could see for a little while until we get to that mid December time frame this month. Next couple of weeks, get the inflation report, Fed's response to it, where we could look for that next and final leg down based on what the Fed does. So if we get a hot inflation print and the Fed has to, raise higher than 50 basis points, I don't think they're going to do that without kind of telegraphing that move. But if they were to come out, higher than 50 basis points, the market would really take another leg down. But if they just come out with 50 basis points, everything else is equal, inflation comes in at par or a little bit hotter, then markets will probably, take another leg down. And then the smooth sailing to the end of the year could see a nice little Santa Claus rally. Bitcoin could sit here and rally in this range for quite a while as it works out the next level like it's been doing all along the way, as the rest of the crypto market kind of works its issues out with the FTX fallout. Sam Bankman-Fried, big interview yesterday. Very interesting in terms of how he acted, responded, the questions that were asked. A lot of people think he's just outright lying. Some people think he's delusional. Could be a strategy on his part to try to paint the picture that he did not know that funds were being commingled and that there was illegal activity going on. So it'll be interesting to see how this all unfolds, whether or not he ends up actually getting arrested and where things go from here. On another front, the CFTC is saying that Bitcoin is the only commodity in the space in the wake of the FTX collapse. We've talked about that before in terms of Bitcoin being a commodity, basically digital property because of its decentralization, and versus other tokens that are issued by organizations, companies, protocols that are controlled by individuals or groups, whereas Bitcoin obviously is the most decentralized, even though it's not completely 100%, it is the most decentralized in the space out of all of them right now. And it is it's computer code. So it's a digital gold. It is digital property. It is a commodity, which is good. If it gets labeled a commodity, falls under CFTC, then you could start to see, potentially spot Bitcoin ETFs coming out, things like that. So that would be a good thing for Bitcoin, good thing for the space. It could start carving its path out as more of a store of value, being labeled and regulated as a commodity versus, right now where institutional capital is still basically backing off, staying away from the space right now while the dust settles and things work their way through the pipeline. So these are the things I'm looking at. I'll see you in the next video.